this video, we talk coronavirus, or rather its effect on the market. More importantly, its effect on my portfolio. I think I'm gonna be sick. How I responded, what does it all mean? By the way, YouTube apparently considers coronavirus a naughty, no-no word. Channels are getting demonetized for some weird reason if they say the C word. Lucky for me, no one watches my channel, so we can go corona crazy here. Maybe every time I say coronavirus, you drink a Corona. No, don't do that. But I am invested in Constellation Brands, ticker symbol STZ, which owns Corona brand. So if you're gonna do it. All right, moving on. If your business model relies on people congregating, particularly in tight quarters, and moving them across borders, this has been a very bad couple weeks for you. Before we get to my thoughts and what I'm doing about it, let me delegate some of the statistical color commentary to The Compound. I really enjoy these guys, so here is a short segment of a video they released a few days ago. I'll see you back here in a hot minute. Actually, make that a cold one. I'll see you back here in a ice cold Corona minute.
This is from Steven Suttmeyer at Bank of America Merrill Lynch. It was the second largest consecutive 7-day drop since 1950. The sixth largest consecutive 7-day drop going back to 1928. I mean, these were extraordinary numbers. Last week, the S&P 500 went down 11.5%, 12th largest weekly decline back to 1928. And if we exclude the Depression in the 30s and early 40s, it was the fourth largest single week sell-off ever, led only by October of 08, which is like post-Lehman.
My favorite was from Krinsky, John Krinsky.
Yeah.
In 10 days, stocks went from a 52-week high to a 52-week low, which has never happened before.
What index is he looking at, though?
So I forget. He was looking at an index. It was like, I think it was the Dow, the industrials, the transports, and the railroads combined. There's something along those.
Utilities, railroads, and industrials.
Something like that.
It's the Dow composite.
So a 52-week high to a 52-week low in 10 days. Unbelievable.
It's ridiculous.
Yeah.
Well,
Never happened?
And it's
Never happened.
And it's not like it was a flat market to go from a high to a low. Like, it was a very, very wide low to high 52-week situation.
Another interesting thing about this was that this all happened in the context of a rising market. Like, just defined simply by the 200-day stocks being above that. Usually these like crazy washout moves happen naturally below.
You know what's really funny? I think you did a post about how stocks don't crash from all-time highs.
Well, in 2018 I did that because that was so unusual. In December 2018 that happened.
So you might have to like revise that.
So
post.
in December 2018. We sold off 10% in 9 days, which had never happened, especially from an all-time high, and we saw something similar.
But right. So we were at an all-time high in September of 18. This was literally making an all-time high on a Wednesday, and by the following Monday being down 7%, and then following all the way through being down 13% at the low. I mean, it's pretty extraordinary.
All right, so let's get on with it.
I guess my comment or question for you would be, like, why are we still always surprised when unprecedented things happen? Like, we only have 200 years of legitimate stock market data, and arguably the world that we live in now looks nothing like it did 100 years ago even.
Well, what do you mean, why are we surprised? Are we supposed to be like
unprecedented things happen every day.
Yeah, and they're always like unexpected.
Right, so without a doubt, this is very unprecedented.
Yes.
But it's like, that's what it is. So, and that's why they call it risk.
All right, wait, so was that a question? Did you have a question for me, or is it my turn?
No, I just wanted to do a soliloquy.
Okay.
It's your turn.
Peak to trough, the Dow lost approximately 13% of its value. We don't know yet if we're in the process of bouncing off that bottom or if we're going to retest those lows in the future or if we'll break through those lows and continue downward pressure. Because of the nature of coronavirus, the uncertainty of its future impact, predicting where we go from here is particularly difficult, and that's a big reason why the market is behaving the way it is. I want to make a quick critique of the media. Yes, this is going to be a rant, and I apologize for that. Feel free to skip ahead to the more juicy tidbits provided later in this video. First things first. 1,000 points just isn't what it used to be. In October of 1987, on what would later be referred to as Black Monday, the Dow lost 22% in a single day. How many points was that? 500,000. Nope, sorry, that's a decimal point, not a comma. On Black Monday, the single worst day in stock market history, the Dow lost 508 points. Wait, 508? I bring this up only to illustrate we really should think of these things on a percentage basis only. 1,000 point loss headlines are needlessly alarming. Points don't matter without proper context. 1,000 point single day losses have never happened before. That sentence sounds really scary, but corrections happen all the time. Pullbacks of 5 to 10% happen on average 1 to 2 times a year. Corrections defined as declines of greater than 10% happen at least once every year and a half or two. These typically last a few days to a few months, and on rare occasions they can last a year or 3. If you routinely watch financial news media, you might come away thinking a buy the dip strategy is what the dumb money investors are doing. Yes, it's been a good strategy during this particular record bull run, you might hear, but surely the chickens will come home to roost eventually, right? Right? I don't know. I hear that rhetoric all the time, but this hasn't been the case, ever, given a long enough time horizon, of course. Instead, we get these bombastic headlines and an endless supply of experts with cash on the sideline waiting for an opportune time to enter the market. This strategy might make you feel better, but it has never, not ever, been an optimal long-term investment strategy. And why the Dow? We hear about it all the time because it just happens to be the largest number, and it's the only way we get these 1,000 point headlines. VTI down 7 points just doesn't have that Pavlovian response. The Dow Jones is only 30 companies. 30 important companies, sure. But why not the S&P 500? Surely that's more representative of the underlying economy, no? But if we're going to go that route, why not just one step further? Why not track the total stock market? And maybe let's just add the world index while we're at it. We live in a world where it's never been easier and quicker and cheaper to liquidate our entire investment account. 1,000 point headlines and the Dow-centric focus is not helpful. Just ask Robinhood. 35 years ago, a 1,000 point decline would have represented an 80 to 90% decline in the Dow. Now it's more like 3 to 4%, which is not nothing, but in another 35 years, it may be 0.1%. So can we just drop the points already? Sure, they're cute. I like them. But they don't really tell us anything. I think maybe for this channel, I'll just ban point comparisons altogether. In fact, I'll ban benchmarking the Dow too while I'm at it. This channel is going to be held to a higher standard. The highest standard. Well, actually, I could use the views and subs. I need people clicking on the thumbnail. All right, ignore everything I just said. Rant over. Points or clickbait. Damn it, I'm just gonna have to edit this whole part out. Alright, this is not a video on how real or not real the severity of the coronavirus is. It doesn't matter what I think about it. What matters for the purposes of this channel and your investments are the effects on the market. Spoiler alert, the effects are real. Monday's rally and Wednesday's isn't atypical. Bear markets are riddled with huge upswings. A 5% rally like that would be considerably more out of place in a market that was in an actual healthy uptrend. So don't let these rallies give you a FOMO head fake. What am I doing about all this? Am I liquidating and running for the hills? Is this the end of Lemonade Stand? Or is it time to go shopping? In case you missed it in my rant, I don't think cash positions are optimal, ever. Well, not ever, but there's no way to discern when is the time to be in cash or not. And parking money on the sideline is a losing strategy given long enough time horizon. And that's all you really need to know about that. The entire market has gotten discounted. You've got a discount. You've got a discount. You've got a discount. You've got a discount. The sale here is reflecting new risk and uncertainty that wasn't priced in before coronavirus. I think in these situations, the market is generally handing us an opportunity. That doesn't mean investing now will be inherently safe and or lucrative. Certainly not in the short term, but fast forward 10 years, 20 years, 50. Will you, dying in your bed many years from now, will you be willing to trade all of the days from this day to that for one chance, just one chance to come back here and tell your enemies that they may take your lives, but they will never take our financial freedom? Sorry about that. I really wish I could do proper accents. I think there are a couple buying strategies one could implement on days like these. There are sound strategies like simply buying the total stock market in a low-cost index fund. I don't think there's anything wrong with this, and it's the best strategy probably for everyone. But what is that crazy lemonade stand guy doing? I think that's what most people are actually asking themselves. themselves when they go to bed at night. I'm taking this sell-off as an opportunity to shift my risk. I'm currently selling positions in companies that have been struggling, companies that I was looking for a turnaround in, or reversion to the mean, or just hoping for a miracle. Looking at you, Tanger. Come on, boy. You can do it. I took the equity from these securities and rolled them into a different kind of risk, which I'll break down in a minute. All these positions were in the red, so there aren't any tax implications with these trades. But before we get there, I think you can make the case, if you're gonna pick stocks instead of buying a broad-based low-cost index fund, that you should look for companies that have or may benefit from a pandemic. Think Clorox, Domino's perhaps, certain pharmaceuticals. The other idea would be to buy stocks that sold off with the market but don't have a tangible direct connection with the coronavirus. Anything in travel, for example, would be tangibly connected to corona. I actually sort of did the opposite of this though. First off, the easy money has already been made in anything that materially benefits from coronavirus. If you were invested in these companies already, congrats. If not, don't chase it here. Second off, I don't know. My risk tolerance is like my morning breath. Pretty strong. Buying companies like Apple with supply chain issues was probably a good bet. Apple at 260 was probably an opportunity. That remains to be seen. We'll see. My strategy, however, has been, for the most part anyways, was and still is buying into the depths of this corona carnage. Simon Property Group, Spirit Airlines, Royal Caribbean, Carnival Cruises, and Disney. That's tickers SPG, SAVE, RCL, CCL, and DIS. All of these names have been hit really hard, and frankly for good reason. The bet here being that the juice is worth the squeeze, that the market is discounting, or rather over discounting, the worst case scenario. Personally, I just don't think it matters ultimately, not big picture anyways, so why not buy the names hit the hardest, just as long as the underlying business model remains intact. That's sort of the key. Well, it's about time. Let's just jump into the charts and I'll donate some of my quick thoughts on these companies. All right, guys, welcome. If you're coming from the long portion of the video, I'm going to try to go through this quickly. What you're looking at here is Fast Graphs. It's a fundamental software analyzing tool. I really like it. What we have here in front of us is Carnival Cruise Line, ticker symbol CCL. I covered them in a previous video, so I'm not going to get into all the details here. Few things I want to point out. So from this period of early 2018 to late 2019, you see there's a depreciation in stock price by 40%. Now, there's a lot of reasons for that, why that happened. But what I want to point out here is that during this period that the earnings actually went up. So you have a stock that's getting cheaper on a price basis, but it's also getting cheaper relative to its earnings. I love when that happens. Those are buying opportunities in my opinion. And I started buying this stock in the 40s and started to make some money on it. But then this happened, and here we have another drop in the stock price. This time it's 45%. The difference being this time, this drop will actually reflect the earnings. This light shaded green area are earnings that are projected. So analysts that were already projecting for 2020 for it to roughly be flat, down 1%, with 2021 and 2022 having double-digit earnings growth. Now, these earnings haven't come down yet, but they absolutely will come down. It's just, it's not reflected in this graph yet. So this response back here, not reflected in the earnings. Now we have this another huge drop, approximately the same percentage drop, and it is going to be reflected in the earnings. Now, what remains to be seen, is this an overcorrection? Is a market overreacting to what might happen with these earnings in the future? I think the answer to that is yes, but you never know. You're not going to know till later this year or next year or maybe a couple years from now to really paint the picture whether this was a good opportunity or not. I'm betting that it is a good opportunity. So back here, you could argue that Carnival was, fair value. It's trading just above its normalized PE for this period. This blue line is a normalized PE. And then since then, we've had a drop of 61% in the stock price, while, as said earlier, the earnings have actually gone up. Kind of flat, though, in this period, but have gone up and are expected to go up in the future. I still think 2021 and 2022 are good. Maybe 2021 less so, but 2021 and 2022 should be good. This year is going to be rough. Again, I think the bet here is that this is an overreaction and that there's, double-digit annualized returns here in the future. if it went back to this normalized PE, if these earnings projections were correct, you're seeing massive gains in the stock price, and you're getting a dividend yield at 7.18%. It's pretty impressive, and the dividend is expected to grow at about 5%. You see projected for 2022 is $2.20. It's currently $2. Again, Carnival Cruise Lines is obviously a cruise line company. They also have hotels and resorts. In regards to the coronavirus, this is the exact type of company you wouldn't want to be during a coronavirus scare. Maybe worse is Disney, and I'll get to that in a minute. But again, if you believe in the long-term fundamentals of this company, then this seems like a good opportunity. I just want to point out one more thing before we move on. Here is the same chart I just zoomed out. The cheapest this stock got during the Great Recession, January of 2009, we're looking at right here. The price was $18.19. The PE was 6.52. The price earnings ratio is 6.52. You're getting it less. It's cheaper than it was in the Great Recession. The price is almost $28 right now, but on a PE basis, it's the cheapest it's ever been. Even here after the .com bubble, you're looking at 11.5. So great value right now, great dividend yield. I think that holds. However, if there's a credit crisis, going back to the Great Recession here, you can see this white line is the dividend. It was going up nicely into the Great Recession. They cut it, and for good reason, and they reinitiated it here in late 2010, and it's had nice earnings, it's had nice dividend growth through this period. So this company, it's capital intensive. If this coronavirus thing escalates into a credit crisis where banks are no longer lending money, people maybe lose their jobs, or they're not making as much money as they were, and they're not going on vacations, you're going to look at trouble with this dividend in the future. I don't think we're there, even though there will be a hit to earnings this year at least. I think the dividend is relatively safe. All right, that's enough with that. Let's move on to the next company. And I'm going to do these in alphabetical order. So this was CCL. What's next? Disney, I think. DIS, yeah. All right, so here's Disney. Disney has a category here as a media conglomerate. Disney's known for its parks. They have a cruise line. People fly from all over the world to go to Disney. People are scared to get into planes right now, and flights are getting canceled left and right with the coronavirus. So Corona hits their park business. It hits their cruise business for sure. They make a lot of money from their movies. A lot of people are probably scared to go in theaters right now as well. The only thing that's good for them is their new streaming service, actually. So I want to talk about that a little bit. Let's zoom into this chart. I'll cut time off the graph here. I just want to show this. So this is mid 2015 to early 2019. The stock was flat. The price down 7.5%, but when you factor in dividends, it was down less than percent annually. And you can see that the stock traded in a range here. I'm cherry picking here a little bit. This one I want to show you guys though. This huge spike here was the announcement of the streaming service, Disney Plus. From that point to the peak before Corona started taking over, you had a 36.5% increase in the share price in a pretty relatively short period after having years of it trading in this trend. And what's interesting is we're basically back at those prices. We're back at the pre-streaming service prices. So yes, Disney is going to definitely be affected by the coronavirus. For how long, I don't know. But people aren't jumping on planes. People aren't jumping on cruises for a good reason. Oh, and Disney owns hotels too. So there's another thing. So hotels are problematic as well right now. But Disney is a great company, and you're buying it at these pre-streaming service prices. So I don't know how sold I am actually on the streaming service, but the reason why I had this huge jump is the market loves subscription services. It's not going to be capital intensive in the way a park is, or cyclical the way a park is. It's easy for people to pay a monthly subscription, sit at home, and Disney just makes money. The reason why this is interesting to me is, and here, let me take some time off the graph to illustrate this better. So Disney was trading at a PE of about 17.5 for this time period, and actually And actually, that's how they've been historically, absent the dot-com bubble, where they were, like many other companies, very overvalued. So that normalized PE would be higher if I included the dot-com bubble in this graph. But the point is, they've been trading for a long time, about 17 to 18 PE, with periods of real high overvaluation, and then if you're lucky, some periods of lower valuation. Here it looks like its valuation is really high, but I think this is a new multiple that the market is assigning to this company because of the streaming service. We'll cut this time off again. You got a PE here of 21 to 26. I think that's going to be the new range. Once we get past this coronavirus moment, which again, that just brought us back to where Disney was. So you're buying Disney pre-streaming service prices right now. I think that's good. Dividend yield, not great, but they are growing it. I think it's a great company. I was invested in them through here. I wish I owned more shares before this jump, and now I'm getting the opportunity again, so I'm buying into them. All right, let's go to the next company. All right, this is a Royal Caribbean's chart, ticker RCL. Again, this is another company that I just went over in a different video. Check that out for more details. It's mostly pre-Corona. I think Corona was starting to come in the headlines, but we didn't see the price action yet. So check that out. Just know the proper context. Come back here. I really like RCL. I like it a little better than CCL, but just hit so hard. They have the same issues that CCL has. So again, if there's a credit crisis, this dividend is probably not safe, but save for that, you're getting a current starting dividend yield of 4.75. The compounding annual growth rate for this dividend has been 12%, and if you just look at since the Great Recession, where they cut it, the earnings dividend growth rate has been substantial. We're looking at more than 20% a year. If they can keep that up, who knows if that's possible. Your yield on cost, 10 years from now could be very, very substantial. Capital appreciation, you're looking at 186% if, the stock could return to this normalized PE based off these analyst projections on earnings. Again, just like Carnival, this year, these projections are going to be rich. I'm looking at negative earnings growth, not negative earnings, but negative earnings growth. This green bar is going to come down a lot. Peak to trough here on the Corona fall, you got the stock lost half its value in a pretty short period of time. You're getting a PE of 6.86 right now. What was it during the Great Recession? Oh, it was super cheap during the Great Recession. But look what happens when you buy at that price. Cherry picking, of course, here, but 34.3% annualized returns, and that's without a dividend during a few years here. And another thing to think about, that 34.3% does not include reinvested dividends. I think it's always important to factor that in. I'm going to cut time off the graph just so you can see how the earnings have looked more recently. Again, I think cruise lines have finally gotten their act together, and they're actually a pretty good business model. You have operating earnings of 21% during this time period. Again, I always like to buy companies like this. So you get the share price, $101 back in 2015. We're now at $65. That's a negative annual. I don't know what the annual is because this is including dividends. The share prices fell 35% during this multi-year period, while the earnings have gone up substantially. And I think the earnings long term will continue to go up substantially. Not this year and maybe not next year. But I'm a long-term investor, and I think this is a really good opportunity. One thing to note, I forgot to mention in the other for the other companies, the credit ratings and the long-term debt to capital. I was going to go over EV to EBITDA as well, but I forgot. Anyways, 37% long-term debt to capital. I think CCL is less than that. And I think CCL's credit rating is also better, but forgive me for skipping that. Trying to blast through these. All right, let's go next to Save Spirit Airlines. All right, this is Save Spirit Airlines. If you're not familiar with them, they're an airline company. They're like the affordable, cheap airline. I've flown on them before, and not the best experience in the world. Definitely your value airline. But I love their earnings growth. And again, it's one of these companies that I love the earnings growing while the share price falling. To me, that just creates opportunity. These are buying opportunities for me. Again, the caveat here is that these projected earnings not going up like you see here. It's going to be negative for this year anyways. Well, beyond that, I don't know. Long-term good. Again, if there's a credit risk, they're going to be in trouble. Probably more so than the cruise lines. You've got a credit rating that is less than investor grade. Long-term debt to capital, 54%. Not great. Also, this company doesn't offer a dividend. They might in the future. I don't know how that could be years from now. A lot of airlines offer dividends, and we're looking at operating earnings here, but they've got good cash flow. So I'm going to just change the chart to operating cash flow real quick. Yeah. So operating cash flow growing pretty quickly, 34% here. I think the operating earnings were growing at like 22%. Yeah. So I like them. It's more spec. I don't have a lot of money invested in Spirit. I don't plan on putting a lot of money in them, but they're attractive to me right now just because of Corona, really. If you get a reversion to the mean, you have substantial growth in the share price here. Again, it's not a dividend company. If that's your cup of tea, this is not it. I'm not invested in Delta. I'm not invested in Dell or Delta, but I do want to just show them really quickly so you can see if you're a dividend person. Here's Delta. On Spirit's chart, we didn't see the Great Recession because they weren't public back then, so we didn't have that data. But you can see airlines did not do well during the Great Recession. Their credit rating is better than Spirit's, and their long-term debt to capitals is better. Again, we're looking at operating cash flow here, so substantial operating cash flow over the dividend. Dividend seems safe. Like I said, we have a credit crisis, then it's not going to be safe. It's definitely not going to be safe. But I think, risk brings with it opportunity. This looks, it looks pretty good. Let's cut time off. I just want to get it more reflective of comparing it to Spirit, not getting the same operation cash flow growth rate. Okay, I switched this to operating earnings. Growth is good. Projected growth is good. They're not projecting any growth for this year. I don't know if I don't pay attention to this company, so I don't know if estimates have already come down or not, but I would not expect earnings to be great this year. They've been hit pretty hard with Corona, and the fundamentals are going to be hurt this year. Long term, I don't think so. That dividend growth rate looks pretty good. Let's check out the performance chart. Yeah, so the compounding growth rate for the last 6 years has been 52%. That's because the dividend started from zero. So if you X this first part, you're still getting substantial growth. It was 15% in 2018. I'm not about to do the math on this, but I think that's slowing down. Just looking at this chart, if there was no, if Corona never happened, then I presume you're getting double-digit earning or dividend growth rate for this company, and the starting yield is 3.5%. All right, let's move on. We just did save. Let's do SPG. SPG is my last one, I think. All right, yeah. SPG is a REIT, a real estate investment trust. I've talked about them in the past on previous videos. You have to look at operating cash flow. So I'm going to change this to operating cash flow. You need to use operating cash flow for all REITs. That's the go-to metric for REITs. One thing I want to point out is the long-term debt. It's 80%, the long-term debt to capital. On the face, that seems very high, but it's a real estate company. Debt is sort of the product. And we are in low interest rate environments. Debt's getting cheaper, so REITs look good right now. And this is a company that comparing it to the cruise lines that they lost their dividend coming out of the Great Recession. SPG held on. They kept paying. Though you see the dividend dipped. They went from $3.31 a share all the way down to $2.44. But it never went away. And then in a couple more years, it was back up over that pre-recessionary time. And it's grown quite nicely. Again, if there's another credit risk to the market, the dividend, I would say it's safe, but you're likely to get a cut for a few years. This is another company that's been beaten badly. It's got that, the negative growth to the share price while the earnings are actually growing. I love that. And here more recently, you've had this huge decline from the coronavirus. One thing to point out, this isn't just a REIT. This is a mall REIT. And that makes it even more scary because the whole retail apocalypse, Amazon taking over. But one thing I want to point out is this company has continued to increase their earnings even through this whole Amazon era. And that's because their portfolio is very high quality. If you go to their malls, they're still doing quite well, obviously. I just wanted to zoom in to get a more near-term picture. So see, the blue line is this normalized P for this period. It's obviously been trading under that for a number of years. Obviously, people are not congregating in malls right now. Like hotels, cruises, airplanes. Malls are another place where people congregate, and hence the corona impact here. So because it's a REIT, they're collecting money from their tenants, and their tenants are companies. Those companies are going to make less money, but that doesn't necessarily translate to less rent for SPG. Now, if they lose tenants, that hurts them. If they don't lose tenants, but their tenants lose a lot of money, they can renegotiate lower rent, so that's a risk. However, I don't think this drop is, or for that matter, this drop here reflects the reality of the situation. I think this is long-term a great company. How long it takes us to get back to this normalized PE, I have no idea. It's going to take a little longer now because of the corona, but I think you've got a lot of potential growth for this company in the future. The operating cash flow growth during this period has been nearly double digit. You're getting a starting dividend yield of nearly 7%. And the company has been growing that pretty quickly. Double-digit earnings growth the last 8 years. Let's check out the all chart. All right. So this is going back to 2000. Yeah, you have near double-digit for this 19-year period. You have near double-digit earnings growth. Dividend growth. The dividend payout ratio, 60s, 70s. That's completely normal. Actually, it's a little low for REITs. They generally pay a higher portion of their income back to their shareholders. That's for tax purposes. I want to check the analyst scorecard. So analysts have been very, very accurate at projecting the earnings growth for this company. And again, lighter shaded green area is the projected earnings growth. Again, this is probably coming down if they haven't already lowered guidance on this. Though I think they're at less risk than, say, the cruise lines and Disney for that matter. So yeah, you're buying this company for a nice reversion to the mean play. Whether it happens this year, next year, the one after, I have no idea. But in the meantime, you're getting 7% yield. It should continue to grow just as long as we don't have a larger credit risk. Well, that's it, guys. Tell me what you think in the comments. Which of these, if any, of these companies are you buying? I do want to know, are there other thoughts you guys had? Are you looking at the names that have been beat up a lot, like I am, or are you looking for companies that are maintaining strength during this corona time? I don't know what the best strategy is. I don't have an idea, and I don't think anyone has an idea of what are the best companies to buy. Like I said in the other video, I think buying a broad index fund is probably the best. It's certainly the safest bet. But I think substantial returns when you buy these companies, they're just destroyed. I think the reward is worth the extra risk, I think, in these names. But that's to each their own. If you're an older person, I'll let you define how old is old. You may want to, stay away from risk like this. But if you're in your 30s, if you're in your 20s, oh my God, take some risk. Even if you're in your 40s, damn it. But all right, guys. That's it. I think if you have a well-conceived long-term investment strategy, then buying, regardless of the macro trends, actual or perceived macro trends, is the correct strategy. None of this is financial advice. I'm just an idiot on the internet with a lemonade stand. I'm long everything mentioned in this video. Well, maybe not. I don't know. I'm long SPG, SAVE, RCL, CCL, DIS, and even Tanger, though I did reduce that position. That's it. I'll see you guys next time. Peace.